One thing that I think's super important to put this into context, and I'll try and tell this quick. I had a meeting once with Howard Marks, who I'd wanted to meet for a long period of time. He's a famous bond investor that does a lot of writing. And for 15 minutes, he asked me questions about the venture industry, a lot of structural questions. And I told him my answer as best I could. And he said, "Man, that's a really shitty industry." And I said, "Well, why do you say that? What do you mean?" He says, cyclical collapse is built into the structure. And so we have funds that, are taken, committed to, that have 10 to 15 year lives. So you have low barriers to entry, but you have very high barriers to exit. And so he felt that it was just systematically set up to rise and crash. And one thing that I realized coming out of that is that it doesn't happen like a sine curve, which is what we all imagine when we think of a cyclical business. It's more like a sawtooth. Risk on is a very slow process, and it's reflexive, so it grows and grows and grows and grows. And then risk off tends to be very abrupt. And we've seen that here, right? This cycle, risk on was from 2009
That's well said.
to 5 months ago.
That's really well said.
And risk off is 5 months. And the thing that's really tough about that is it requires mental adjustment very quickly, because it didn't gradually change, it abruptly changed. And so, cap charts might have, systematic issues that are stuck because too much lick pref relative to the new reality. Valuations have shifted. The cost of capital is radically different. You may have, on the way up as people took more risk, you tried crazier things. You're willing to make investments in businesses you might not if the cost of capital is a lot lower.
You name a stadium for 5 years as a crypto company.
You might do that. But then all of a sudden it's gone.
And now the commitment to naming the stadium is greater
than your market cap?
Than the market cap.
Yeah, well, I assume you're referring
Well,
to
that may not
SoFi.
be true for FTX, but
Just as an example, it might be a disproportionate value of your market cap.
So anyway, it's tough. And in this particular case, because that's what you asked. So it turns out 2009 wasn't that bad. If we have an 2009, that'll be pretty good. Things got turned around pretty quickly. 2001 was very abrupt, and we didn't really start to see liquidity again until, with a few exceptions, Elon mentioned PayPal, but like 2005, 2006.
It was a long walk in the desert. I mean, a lot of great companies were started, but a lot of founders gave up at that time, right?
Yeah, and look, I mean, I think if you're an early stage investor, or if you're an early stage founder that's just getting going, or even an early stage company, because if you haven't scaled out yet, this probably hasn't affected you. It could be wonderful. Like, your access to talent's going to be a lot easier. People are going to be more pragmatic and rational, but it's usually a long window on the other side. The other challenge you have here is in 20. We basically had a mini pullback in March of 2020, but then the Fed hit so hard that things just blasted off again. And now you guys have talked about this, but that tool's not in the toolbox anymore.